Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll be discussing findings from the latest corporate earnings season for the first quarter and how they impact markets. Investors always watch corporate earnings announcements carefully, but there has been extra attention on company results this quarter. This is because investors are looking for hints as to whether the economy is slowing or if it will continue growing steadily. After all, factors like high interest rates take time to filter through the economy and impact consumer spending and corporate profits. Over the next few minutes, we'll discuss earnings outlook and why long-term investors should be focused on these trends rather than focused on day-to-day market swings. First, it's important to remember that the stock market tends to follow the trajectory of corporate earnings over time, a pattern that is clearly shown in this chart. While investors may focus on the economy, we do not invest in the economy directly. Rather, we invest in the stock market, which depends on the financial performance of companies. In turn, how companies do depends on the underlying economy, including consumer spending, the job market, inflation, and more. This chart also highlights how we can think about stock market swings. During difficult periods when the stock market might decline, a strong economy will help to support stock prices. After all, if a stock price falls when earnings are strong, valuations will become more and more attractive. The situation is different if the market falls due to an economic shock or recession. That's why bear markets tend to occur during recessions when it's unclear what the earnings outlook might be. Thus, corporate earnings are among the most important factors for long-term investors. Next, this chart shows the earnings growth rate of S&P 500 companies since the mid-1980s. What you can see on the right is that earnings struggled in the past few years, but began to accelerate again in the third quarter of 2023. There's been a delayed effect between steady economic growth and corporate profits, but there are signs that companies are beginning to benefit from economic trends. This also matters because many valuation ratios depend on these financial measures. The price-to-earnings ratio, for example, has risen significantly over the last 18 months as the market has rallied. The ratio is now around 20 times forward earnings, since the earnings growth rate was stagnant over much of this period. However, with earnings growth rate now accelerating, there is hope that valuations will begin to look more attractive. Another way to put this is that investors have anticipated stronger earnings growth, which led markets to rally ahead of time. Finally, this chart shows that economic growth has been steady over the past several quarters despite investor concerns. In fact, the number of references to the word recession in corporate earnings calls fell to its lowest level in 2 years. Other sources of data, including the Federal Reserve of Richmond's CFO study, suggest that corporate executives are increasingly positive on the economy. While these figures can change, they are positive, and they do suggest that steady economic growth is translating into better corporate profits. The hope is that this also supports the stock market just as it has done over history. This is an important reason why investors should focus on longer-term trends rather than daily stock market movements. We hope you found these insights helpful. We would love to discuss any of this in more detail. If you'd like to, please don't hesitate to reach out. We look forward to speaking with you soon.